Hey, welcome options traders. And a question that I get a lot is about option strategies and how they relate to one another. And it's an interesting question because many times new traders think that each strategy just stands by itself and they don't need to understand how they're all connected. But if that's the way you think, you're going to potentially step into some very big traps. One of my favorite examples is the dangers of in-the-money options for diagonal spreads. Now, by an in-the-money option, I'm talking about the long position for a diagonal spread. And if you go too deep in the money, which is what a lot of people like to do for maybe what we call a stock replacement diagonal spread, you can step into some very big traps. So as a quick review, let's look at what a calendar spread is. It's also called a time spread. And that's where you're going to buy a longer dated call and you will sell a shorter dated call with the same strike. So for instance, you might buy the March $100 call and sell the January 100 call. So notice that we have the same strikes, but different expirations. Now, if you're long the longer dated one, it's a long time spread, and it would be a short time spread otherwise. Now, the way that I have set this up in this example, it would be a net debit, and that's because you are purchasing the longer dated call. So that's the calendar spread. And really the motivation for this strategy is that the shorter dated option, or the January in this example, that this call will decay faster than March, or faster than the one that you're long. So both options decay. But if January decays at a faster rate, then assuming that the stock price stays reasonably quiet, you will end up with a profit. So this is what the risk graph looks like for a calendar spread. And it's easy to see if you look at the expiration graph here in blue, lines right up there at 100. In that example, that would be the current stock price. Now also keep in mind that this blue curve, when we talk about it being at expiration, it really means expiration of the short option. And then this curve in red, of course, is our current curve. And then over time, the red curve moves towards the blue. But the main idea is that we want the stock to sit still and we're looking for time decay to work in our favor. That's going to be important in a moment, that we want time decay in our favor. All right, so hold that thought. Let's jump over to a vertical spread. What's a vertical spread? Well, we've talked about these many times before. You're going to purchase one call and you're going to sell another call. They have to have the same expiration date. So as an example, you might buy the January 100 call and sell the January 105. We have the same expiration dates, just different strikes. So in this example, this would be a debit spread, and that's because you are purchasing the lower strike call. So we've talked about this before in pricing principles, that if you have the same expiration date, the lower strike call must cost more money. It's giving you the right to pay less for the stock. And so because that's the one that you're buying, this is going to be a debit spread. And in this case, this would be our risk graph. There's the bend of our long 100, the bend at the short 105, and the red curve is the current curve. And as before, the red curve over time starts to move towards the blue. Okay, so that's the vertical spread. Now let's take a look at the diagonal spread. So the diagonal spread is where you are going to buy one call at one expiration. You could also use puts, but I'm going to use calls for these examples. You're going to sell another call at a different strike and a different expiration. The diagonal spread has both of these different strikes, different expiration. So as an example, you might buy the March 100 call and sell the January 105 call. So notice we have different expiration dates and different strikes. Now the way that I have set this up, it will also be a debit spread. And that's because you are purchasing the longer dated option. All things being equal, that will cost more money, but you're also buying the lower strike call, which, as we just talked about, will definitely cost more money. So you're buying the more valuable expiration and the more valuable strike. So that absolutely means it is going to be a debit spread. Now, depending on how you set this up, we could certainly have short diagonals, and even in this case with a long diagonal, it could be a credit. What makes it a long diagonal is the fact that you are buying the longer dated option. This is also another little key piece of information that can cause problems. So here is the risk graph for that diagonal spread that we just saw. The blue is the expiration at the short-term option. The red is the current curve. And as always, the red curve moves towards the blue as we get towards the expiration of that shorter dated option. So what is the point of all three of these? Well, the diagonal spread is a combination of the vertical and time. The time is also, remember, sometimes called a calendar spread. I've talked about this before in a previous video, but this is an interesting and very important link that you must understand, especially if you are trading diagonal spreads. And even more importantly, if you buy an in-the-money call as part of your diagonal spread, which a lot of traders do, then you may be using a disadvantageous calendar spread. You might have a mathematical edge against you, and in those cases, you may be better off just using the vertical. So yes, I know it can get complicated. It's like a tangled web, and it can be very hard to pull apart. But part of the point of this video is to show you why it's so important to understand these details. It's real easy to just say, oh, I'm going to use a diagonal spread and think that everything is perfect. So let's jump over to an Excel spreadsheet and see why this can cause a problem. So in this Excel spreadsheet, what I've done is I'm looking at three different strikes, the 85, 105, and 110. We've got different expirations. I have January, February, and March. For this video, we're just going to be looking at January and March. And I've thrown these into a pricing model just for round figures. I put 30 days to expiration for January and 90 days to expiration for March. I use 30% volatility, and these are the option prices that we got. So in this example, I've started with a stock price of 105. That's why it's in red. Now, a lot of times what traders do is they like to buy a deep in the money call as part of their diagonal spread, and they'll say, well, I want it to behave like stock. And this is sometimes why it's called a stock replacement diagonal spread, or sometimes people will call it a call-on-call covered call. It goes by a lot of different names. But the idea is that traders are trying to make this call super deep in the money so that it behaves about like stock. So we're going to look at the 85 strike. Remember, the stock's at 105, so this is 20 points in the money. So our March option, according to the pricing model, is worth $20.50, and the January is worth $20.02. Not a big difference. And that's because they're so deep in the money that the insurance value of both of these, the implied put, has dwindled down to nearly nothing. So now let's take a look at the 110 call for January, 30 days to expiration. It's worth $1.71. So again, what a lot of traders will do is they would like to buy maybe this longer dated option deep in the money, then they want to sell a higher strike call against it. And again, the idea is that you're just trying to push this option so deep in the money that it has virtually no extrinsic value and therefore is stock. So take a look at this. Is this going to be a good trade if we pay $20.50 for the March 85 and we sell the January 110 for $1.71? Well, a lot of times traders will say, well, of course, you've only got 50 cents of extrinsic value here, $1.71 here. What could be better? Well, again, this is where you need to understand the connections. Remember that this diagonal spread is really a combination of the calendar spread and the vertical. So take a look. Let's just look at the calendar spread or the time spread. If we pay $20.50 and we collect $20.02 by selling January, the time spread is going to cost us 48 cents. Now, think about it. What was the reason for the calendar spread or the time spread? Because we want the short to decay at a faster rate than our long. But take a look at what's happening. We've only got 2 cents that can decay off of the short. We've got 50 cents that can decay off of the long. We actually have it working against us here. There is no advantage whatsoever. This has got a negative edge to it. But let's just say hypothetically that we bought this spread. All right, so we're going to buy this option. We are going to sell this one. And then we decide that we would like to also do the January vertical. So I want to buy this 85 and sell the 110. Well, notice what's happening right here. these cancel out, right? Because it was part of the short on your calendar spread and it's the long on your vertical spread, so it's gone. And when it's all over and done, you're just left with a diagonal spread. And that's what I said before, that the diagonal is a combination of a horizontal or a calendar spread and a vertical. So look at your cost down here. If we do the vertical spread, we pay $20.02, we collect $1.71. That's going to cost us $18.31, max gain of $6.69. If we use the diagonal spread, we would pay $20.50, collect $1.71, and that gives us a cost of $18.79. A little bit more expensive, and in fact, 48 cents more expensive. Look at the max gains. For the vertical spread, you have a max gain of $6.69. For the diagonal spread, max gain of $6.21. Again, a difference of 48 cents. Where is this coming from? This negative edge over here. That's why your vertical spread costs less and produces more. Now, there are a whole lot of other problems that could creep into this strategy. I'm not going to talk about them in this video. But first, just for a quick one, by buying the longer dated option at not really an advantageous price, you are giving the stock more time to move against you. If the stock moves up, it's not really a problem. We could always roll this one and re-enter the position down here when this becomes the February expiration. But what if it falls? See, if it falls, we have the ability to reestablish it at a different price and still use the vertical. You might not have that opportunity with the diagonal. So that's just one that comes to mind. But again, the main point is that it's so important, and that's what I really try to impress upon all of the new traders out there. You've got to understand how all of these strategies connect. Because if you don't, it's very easy to look at this and say, hey, what's wrong with paying $20.50 for this option and selling this one for $1.71? It's a covered call. Well, not exactly. And the reason is you've got a danger when you're using deep in the money options as part of a diagonal spread. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.